everyone, this is Jimmy Allen, founder and CEO of Investalytix. Let's get into it. Today I want to break down one of the most interesting signals we have seen in a long time, a big spike in fear while the market stayed near record highs. So that spike in fear we saw last Friday, October 17th, is gone now. Fast forward 1 week later, and today is October 24th, the S&P 500 is sitting at all-time highs. Most people assume when volatility explodes, it means sell-off is coming, but that's not always the case. In fact, history shows the opposite often happens. Let's start with the VIX. That's the volatility index, or what traders call the fear gauge. It measures how much movement investors expect in the S&P 500 over the next 30 days. All right, team, let's talk about the VIX. So what I'm showing here in the chart is the VIX. And basically, if we see that last week, October 17th, the VIX shot up close to 29. That's a level, we usually see only when markets are panicking. But this time, the S&P 500 barely flinched. Actually, it was up about 0.53% on that Friday. And today is October 24th, 1 week later, and we are almost 2% up on the S&P 500. Now, that's the key difference. The index held right near its highs, showing underlying strength. Now, when fear rises but prices does not break or move, it usually means traders are buying protection, not dumping the stocks. And that's exactly what I was doing. Basically people are hedging. I was just hedging, and that's what you got to do anyways. And we see that because the price of the S&P 500 didn't move. I didn't dump my stocks. I stayed right in. However, I hedged. And one way to hedge is, covered call, for example. There are other tools you can hedge, but the one I like the most is covered call. And that combination, rising fear and steady prices, has historically been bullish. And basically all it means, there's still plenty of money sitting on the sideline, and that could come back once, all these emotions basically settle. Ryan Dedrick from Kerosene Investment Research showed that basically every time the setup happened since 1990, a VIX spike over 28 while the S&P 500 stay within the 3% of its height, which is basically what we experienced, the market averaged double-digit gain over the next 12 months. This happened October 17th? So hopefully by October 17th of 2025, 25 right now. So by October 17th of 2026, based on history, it doesn't mean it's going to happen again. Is it going to happen? Maybe not. I'm not sure. Nothing is guaranteed here, right? We can't predict the future, but we're going to use data-driven decisions, right? Data-driven decisions. Also, Warren Buffett once said, he said 8 plus 8, if you get around 16, that's okay. Meaning, you get 14, 15, or 17, 18. It's okay. Because basically what he's trying to tell us that it's okay to be approximately right, but not 100% wrong. For example, 8 plus 8, we don't want to get a 2 or 40. So this is just data driven, so it can help us to kind of, plan and have a strategy. I guess what I'm trying to say, in other words, when fear hits its peak, but stocks stay strong, that often marked the beginning of a new leg higher, not the end of the rally. That's kind of what Ryan Dedrick is saying. Also, team, right after that spike that we saw last week, volatility collapsed. The VIX dropped almost 40% in just a few sessions. That's, what traders call a volatility crash. Panic burned out very fast. And it's nobody was going to the exit. They were just hedging. I was hedging, like I was saying. And once that, fades, the market stabilizes and everything just goes higher. And what's today? Today, like I said, October 24th. And that's 1 week. And the market is 2% higher. And here's the chart, of the S&P 500. Just to show that's exactly what happened. Basically, the S&P 500 bounced right back, toward the upper range, right? Now, what I want to do, I want to put this into context, with what Tom Lee pointed out this week. Now, what Tom Lee was talking about, he said earnings season, has been strong, which if you see the numbers, it is strong. We got more than 80% of companies have beating expectation. Small cap profit up over 40%. That's not what a weak market looks like. And I do agree with him, right? A weak market, you would see less companies, right, beating expectation. But that's not what we're seeing. Also, if you look at credit spread, basically how much risk lenders see in corporate debt, they're calm, way below stress level. So there's no sign of real like financial strain. We don't see that, right? I want to go to the next slide, which to basically look at sentiment, right? And I want to show a twist. Despite all that, okay, guys, investor sentiments has flipped bearish again. Honestly, it's been bearish almost the whole year. Almost. I mean, according to the AAII survey, bullish sentiment dropped from 46% to just 33%, while bearish sentiment jumped above 46%. Amazing. You know what I call this? I call this as a classic investor psychology. People are scared of a correction even while fundamental stay healthy. Everything is healthy, all-time high. But everybody's bearish. I mean, the market keep going up, but nobody believes it. Peter Lynch said this: the key to making money in stocks is not to get scared out of them. This is exactly what this moment represents. Fear without breakdown, skepticism without real weakness. I mean, investors are, they're turning bearish despite the strength we see. We're all-time high today, October 24th, S&P 500, all-time high. What does the survey say? 46.1 bearish. But you know what? That's fine. Let them be bearish. I'm buying the dip. We're all buying the dip. Everybody's buying the dip. It's so easy. It's actually, investing is easy. You don't have to make investing hard. Investing is not hard. 8 plus 8, just get around 16. That's all you need to do. All these people, they have these fancy models, quant models. They're just trying to look smart on TV or on Twitter or on YouTube or TikTok. It's all fugazi. You don't need none of that. Just go back to basic. Fear and greed. When they're fearful, we be greedy. When they're greedy, we gotta be fearful. We gotta be careful, right? Here's the takeaway, guys. Volatility spikes are emotional, not fundamental. Fear comes fast and fade faster. Earnings are solid. Consumers are holding up. However, sentiment still overly negative. That combination, historically have been one of the best times to stay invested or even lean in. Market don't usually top out when everyone is nervous. They top out when everyone feels safe. Right now, people are still uneasy, and that's the perfect fuel for another leg higher. And remember, investing isn't about IQ or fancy models like I was saying earlier. It's about patience, observations, and doing your homework. The market reward only discipline a lot more than being, brilliance. If you found this helpful, please give it a like and subscribe to our channel. It really helps us reach out more data-driven investors like you. Head over to investalytix.com, create your free account. Thank you for watching, and I'll talk to you soon.